Hey Lucy, ever think about how hospitals record all the money they make? It's more than just payments rolling in.
I guess they just record whatever people pay, right?
Not exactly. Revenue is the inflow of resources, but it's recorded only when it's earned, when we actually provide the service or sell goods. Even if you pay up front, we can't record it as revenue until we've delivered what we promised.
So if I pay for a surgery in advance, the hospital doesn't count it as revenue until the surgery happens?
Exactly. Until we perform the surgery, it's called deferred revenue, a liability, because we still owe you the service.
Deferred revenue. So it's money you owe the service for, until it's earned?
Exactly. Once the surgery happens, the deferred revenue is moved into revenue, because we've earned it. That's how we keep track of what we've done and what we still owe.
Revenue represents the inflow of resources arising from the ordinary activities of a business. For revenue to be recognized, two primary conditions must be met. 1. Performance. The business must have completed its obligations, such as delivering goods or performing services. 2. Collectibility. The business must be reasonably certain that it will receive the economic benefits associated with the transaction, typically cash.
All right, Lizzie, the hospital receives $10,000 in advance for a surgery scheduled next month. Should they recognize the $10,000 as revenue? No, they should recognize it as deferred revenue. The surgery hasn't been performed yet. Exactly. Now, once the surgery is completed next month, how much revenue can they recognize? After the surgery, they can recognize the full $10,000 as revenue because they've delivered the service. When the hospital sells something like a wheelchair, do they recognize the revenue right away?
Not immediately. We recognize the revenue only when the buyer takes control of the goods. That means you've accepted the product, and we no longer have responsibility for it.
So the sale isn't complete until I've accepted the product?
Exactly. And if there's a return policy, we estimate potential returns and adjust the revenue accordingly.
Revenue from the sale of goods is recognized when 1. The significant risks and rewards of ownership have transferred to the buyer. 2. The seller no longer has continuing involvement with the goods. 3. The revenue amount can be measured reliably. 4. It's probable that the economic benefits will flow to the seller.
A hospital sells 10 wheelchairs at $500 each. That's a total of $5,000. They expect 2 to be returned. How much revenue should they recognize? They should recognize $4,000 in revenue because they expect 2 returns. Exactly. They recognize the revenue for the 8 wheelchairs they expect to keep. How do hospitals recognize revenue for long-term treatments like physical therapy?
For long-term services, we use either the percentage of completion method or the completed contract method. The percentage of completion method lets us recognize revenue as the service progresses. The completed contract method waits until the entire service is done.
For rendering of services, revenue is recognized using 1. Percentage of completion method. Revenue is recognized as the service progresses. 2. Completed contract method. Revenue is recognized only when the entire service is completed.
A hospital signs a $20,000 contract for physical therapy over 6 months. After 3 months, 50% of the therapy is done. How much revenue can they recognize using the percentage of completion method? They can recognize $10,000 in revenue, which is 50% of the $20,000. What about revenue from interest or royalties?
Interest is recognized as it accrues, royalties when the asset is used, and dividends when the right to receive payment is established.
Revenue from interest, royalties, and dividends is recognized based on 1. Interest, recognized as it accrues over time. 2. Royalties, recognized when the asset is used. 3. Dividends, recognized when the right to receive the dividend is established.
The hospital has $100,000 in a savings account earning 2% interest annually. How much interest revenue can they recognize after 6 months? They can recognize $1,000, which is half of the annual interest. What happens when hospitals give rebates or discounts?
We reduce the revenue by the rebate or discount amount. So if a patient gets a $100 rebate on a $1,000 treatment, we recognize $900 in revenue.
Payments from a seller to a customer, like rebates or discounts, reduce the revenue recognized. The revenue recognized is the net amount after applying these reductions.
A company sells goods worth $5,000 but gives a $500 rebate. How much revenue should they recognize? They should recognize $4,500 in revenue after the rebate. What happens when hospitals bundle services, like surgery and follow-up consultations?
We allocate the total price to each component based on their fair value and recognize the revenue separately as each service is provided. For contracts with multiple deliverables, the total revenue is allocated to each component based on its fair value, and revenue is recognized for each part as it's delivered.
A company sells a package for $10,000, $7,000 for a machine, and $3,000 for a service contract. How should the company recognize the revenue? They should recognize $7,000 when the machine is delivered and $3,000 over the life of the service contract. What if the contract isn't signed but work has started?
Revenue can't be recognized without persuasive evidence of an arrangement, like a signed contract.
Revenue can only be recognized when there's persuasive evidence of an arrangement, such as a signed contract or agreement between the parties.
A company has completed 75% of a project worth $100,000, but the contract isn't signed. Can they recognize any revenue? No, they can't recognize any revenue until the contract is signed. Does delivery matter when recognizing revenue?
Yes, revenue can only be recognized when the goods are delivered, and the buyer has accepted them.
Revenue from the sale of goods is recognized when delivery has occurred, and the buyer has taken control of the goods.
A company sells $50,000 worth of goods with terms FOB destination. The goods arrive on April 3rd. When should they recognize the revenue? They should recognize the revenue on April 3rd, when the goods reach the buyer. What if the price isn't fixed yet?
Revenue can't be recognized until the price is fixed. If there is a price protection clause, we have to wait until the price is determined.
Revenue can only be recognized when the seller's price to the buyer is fixed or determinable.
A company sells $20,000 worth of goods, but offers a price protection clause. Can they recognize the full $20,000 right away? No, they have to wait until the price protection period ends. What happens if there is uncertainty about getting paid?
If there is uncertainty, the hospital has to delay recognizing revenue until it's sure it will be paid.
Revenue should only be recognized when there is certainty about the collectibility of the payment. If there is uncertainty, revenue recognition should be delayed.
A company is unsure whether a customer will pay for a $50,000 project. Can they recognize any revenue? No, they should wait until they're sure they'll get paid. How does revenue get presented on financial statements?
Revenue is presented net of discounts, returns, and allowances. In addition, the hospital must disclose how revenue was recognized and any significant judgments made.
Revenue should be presented net of discounts, returns, and allowances. The company must also disclose how revenue was measured, recognized, and any significant judgments used.
A company reports $1 million in revenue but expects 5% of products to be returned. How should they present the revenue? They should present $950,000 as net revenue and disclose the expected returns.